to go into a little bit of technicality, and because I told you the last time we are going to expand more on risk management, and I would like to share with us more technical terms when it comes to risk management, so the RR breakdown. So most of the things that I will share with you today is more of like 9 to 10 technical words that you can use when it comes to risk management, and I'll also give you their definition. So if you are not with your pen, or you are not with your notes, please have that with you, because those terms are very important. They can help you in the course of your journey in this business. So when it comes to RR, which is risk to reward ratio, so basically it's something we use when it comes to trading, and it basically is a breakdown of risk management. So what you are willing to risk, what you are willing to lose, to it's like what you are willing to put down for what you are able to get, like gain. So you are willing to lose this for you to be able to make some sort of amount. So, for example, if I'm willing to lose $10, I want to make two times of that, or I want to make three times of that. Okay. So, RR breakdown. So, the first thing I will be defining to us today, it's our entry price. So, entry price basically, and I will also give you so one is entry price. So, entry price. When we say entry price, what do we mean by that? So entry price basically is the price in which you are buying an asset for. So for example, we have different type of order in the market, and there was a certain time I took my time to explain to us and also define for us what this really means. So, the types of orders that we have market order, and I told you the basic ones that we use, that is very important to us. Even though we have OCO and all of that type of orders, but the main type of orders that is very important and is crucial to us is market order and limit orders. And market order is basically the price you are buying for in the market, that you are buying exactly what that asset is selling for. But limit order is something the price you are willing to buy for. That is basically limit order. So you have a certain price in mind that you feel like is the best price that you want to buy for. So or in the case of the market order, that's what they are selling for in the market, the best price in the market that they're selling for. So you're buying for the current price. So when it comes to our entry price, so our entry price is which is the price in which we are executing for. So, for example, let's say, for example, if you are buying at a market price, if, for example, this asset here, which is Ethereum, is currently selling for 4,178. So, if I was willing to buy at this price, this will be a market order, but then it will also be my entry price. So entry price is the price that an asset is being sold or bought for in the market. So entry price is that. So and then we also have our capital, which should be the second thing we'll be talking about. Do we have anybody here which who is new? Do you have anybody who is new? Please, if you are new here, please type two in the chat box. If you are new, if this is the first time you're coming to this class, please type two in the chat box if this is your first time. So basically, I'll just quickly run up the technical terms that we'll be touching. So I will define to you position size, and I will define to you stop loss. I will define to you risk amount. I will define to you leverage, and I will define to you liquidation. Also, your win rates, and the last but not the least will be break even, which is your BE, and also the technical terms that you can use for all these words that you might find when it comes to risk management. We use all of these technical terms. So the second word will be our capital. So our capital basically, like we all know, we should know, it's very important, it's very crucial. So whenever you hear capital, that's the amount you are trading with in the market. So you are in the market, everybody's capital might vary. So capital is basically the amount you are using to start that business, like the amount you are having. After, for example, your RoyalQ, before you start, you have your subscription for RoyalQ and stuff like that. After you do your subscription, you've banned your account now, but the amount you are using to trade that's in your trading account, that is your capital. That's your capital. When it comes to risk management and how you manage your money management, it's very crucial that you know the amount you are trading with first. You have that fixed, you know, okay, this is the amount I'm having. So now, before we even come to risk management, or you have to know how to manage your money. So you know that, okay, yeah, how much am I willing to? You have to have a trading plan, right? So, and a proper trading plan now will tell you how you are able to manage your money and how you are and your risk appetite. It has to split everything, right? So you have to know how much you are risking per trade, and you know what is the potential of the trades you can take with your capital. So your capital now will be the money you are trading with. So let's go to the next one, which is position size. Position size. So along the line, if anybody does not understand any of these that I'm defining, you can just call me back by either typing, or you can just unmute and ask question, please. So we have position size, and position size is the number of contracts or units of instruments you buy and sell, that you can buy and sell. So the units. So for example, the units of an asset might be, for example, if I want to buy BTC, if it's one BTC I want to buy, if it's two, if it's 10, that's the amount, like that's the position size. So now I say, okay, in this market, I want to buy. For example, here we have Ethereum, this Ethereum USDT. So if I was planning to buy 3 Ethereum for a long, so for a buy, for a long, I'm saying I'm predicting that Ethereum is going to go upside. So I want to go long on Ethereum. My position size, if I was buying 3 Ethereum, will be 3. So my position size will be 3. So if I was also planning to sell, and if it's like 5, that would be my position size, okay? So the units of that asset that you are buying, which for example might be Ethereum, so my position size would be 3, as the case might be, or it might be 5. So the units, the number of that asset that I'm buying, that would be my position size. So without wasting any of our time, let's go to the next technical term, which will be stop loss. So my stop loss is very crucial when it comes to risk management. Stop loss. And I believe I think it was Leader George who took us for the class on stop loss, how you can set your stop loss. Even if it was unfortunately I was unable to attend that class, but I definitely know that it was an interesting class. So stop loss, and I hope by now you should be able to know how to set your stop loss. That is very crucial. So stop loss. So basically, what's your stop loss? So stop loss is where you decide to say, okay, you know what, I'm done. When you are making loss and you feel like, okay, you know what, if this price should go below my entry price, like it's going against me and it gets to a certain price, I want to be out of this market. Okay. I want to be really out. So, in order to close a losing position to prevent further losses. So, order to prevent further losses. And the best definition for that is order to close a losing position to prevent further losses. That's the definition for stop loss. So stop loss is like where you are done, like you are over. You say, no, I don't want to really have more losses anymore. So that would be our stop loss. The definition for our stop loss, and beware all of these terms that we have been using here. This breakdown on our RR. We have used all of these technical terms in one way or the other, even in the previous class that we did. In our everyday trading, we use this. And if you are not using any of these, right, as a trader, you are not being disciplined. Like you are not being accountable for what you are doing. It's like you running a business, but you don't know, you are not managing the business at all. You are just doing it in and out. And that's not the best way to do a business, okay? So the next technical term will be the next technical term will be risk amount. We also talked about this the last time. I believe you should be writing all of these things down. You should be writing all of these things down. So risk amount. So risk amount. So risk amount is the money from your capital that you took out, right? That you are willing to risk on a trade. So now you know that, okay, I have my capital, but per trade, this is the amount I'm willing to lose, that I'm willing to risk to make a certain amount. You understand? Regardless of you knowing that, okay, maybe you know that, okay, you have a set of, you've done your analysis, but then how much the amount you are putting on that trade that you are willing to lose to make a certain amount. So, and this has to do with the futures market, right? So when it comes to the spot market, you're not really risking anything because you are influencing the only asset. But when it comes to futures trading, right, you have an amount that you are willing to risk. So it's not like you want to risk your whole capital on a certain trade. So you want to have a specific risk amount. And the best definition for risk amount is capital you lose on the trade if your stop loss gets triggered. Okay. So now you set your stop loss, but the risk amount now is the amount in which if the trade is going against you, like it's not going the way you predicted it, that amount now will be the particular amount that you are going to lose if that trade should hit your stop loss. So now, but then if you didn't set your stop loss, you might risk even further. You understand? That's why you have to have a specific risk amount so as to be able to know, okay, for you to even have a proper RR, you should be knowing how much you are risking, and you should also know how much you are potentially going to make if that trade should go your way. You see that this is trading is actually one of the best business out there in which you are able to, if you are doing it the right way, okay? is the only business in which you know how much you are risking before you even get into a trade. And you know potentially how much you are potentially going to make if that trade should go your way. So it's not like maybe because some people they trade blind. I'm definitely sure because why? If you don't know all of these things, definitely you would only be trading, and you will be like, okay, if I don't even know how much I'm going to make this trade, if this trade should go my way. And if you are doing that, you are actually blind trading, okay? Because if you don't know how much you're going to make or how much you're going to lose, it means you just pour your money in that trade, or particular trade, and then you don't even know if this trade should go against you, how much you are going to lose. Okay. So, but if you do your proper risk management, you know how much you're potentially going to make and how much you're potentially going to lose if the trade should potentially if the trade should go against you. So your risk amount now is the capital you lose on the trade if your stop loss gets triggered. That's the definition. So your risk amount is the amount you are potentially going to lose if your stop loss gets triggered. So another thing we're going to also define right now is leverage. Leverage. So another thing that we're going to define is the leverage. So do we have, before I want to make this class very interactive, do we have anybody here who can define leverage for me in the chat box, or can unmute and give me a proper definition or their understanding on leverage? What do we mean by leverage, please? Do you have anybody here who can give me an answer to that? Please, if you know that, please type in the chat box, or you can just unmute and tell us what you understand by leverage. Do we have anybody here who can define leverage to me, please? If you don't understand, if you don't know what leverage is, please type 2 in the chat box. But if you know, you can just define it. But if you don't know, don't be shy. Just type the number 2 in the chat box. And we have just 1 minute, and I'll just if not, I'll just define it directly. So do you have anybody who can do that? Do you have anybody who can define leverage? Can you guys hear me? Please. Can you hear me clearly? Can we all hear me? Let me see. I don't know if you can hear me. Hello?
I can hear you, Bobby.
Okay. Yeah. We have Ijoma who said yes, and we have also, okay, the borrowing. Okay, so yeah, I understand that it's borrowing. Yeah, that's true. That's correct. And leverage is the borrowed capital from your broker, right, to open a position that you otherwise have. Is the number of times you want your capital to be multiplied by. Yeah, definitely. Yeah, exactly. Extra buying power. Yeah, definitely. 100%. So your leverage is the amount your broker uh, is borrowing you, their buying power, okay, that you otherwise have the amount to buy if you were to be buying with your own personal your money. So is leverage is the money that you are using borrowed from your broker to be able to enter more positions. Okay, so that is leverage for you, and I'm really glad we have people here who really knows that, because it's very essential. And we also have liquidation. Okay, this is where what my great leader always call in the group, leader Oshai, liquidity is very real. Okay, the liquidity is very real, so you should always protect your account So liquidation, forcible closure of your position. That's your liquidation. So forcible closure of a position, because why? Once your equity runs below to your threshold, it goes to liquidation. So whenever the price is going against you, that is when and your equity, which is your threshold, goes to zero. That is when the exchange or your broker closes your position, and that will be a liquidation. You lose all the amounts that you're using to trade that position. So that's your liquidation. So that's your liquidation. And we also have our win rates. So we have what we call win rates. So we have what we call our win rates, and the win rate is the first is the percentage of or one contrast against the total number of deals you pursue. So for example, I'll make a practical example on win rates. So for example, if you are trading and in a row you make 3 losses and you made 7 wins, your win rate now should be around 70%, okay, out of 100. Because why? You are winning more than you are losing, okay? So that is like the amount of time that you are winning against the time that you are losing, okay? And the best definition for the win rate is the percentage of one contract against the total number of deals you pursue. So if, for example, you are pursuing 10 trades and you have 7 wins and 3 losses, your win rate should be around 70%, like I just told you. So if and the otherwise is if you are pursuing more contracts than 10, okay? So you are winning more time than you are losing. That's your win rate. And there's a formula for that, okay? So the best formula for our win rates is the number of deals divided by the number of deal pursuit times 100%. So that will give you your win rate. Okay. So the last but not the least will be our break even. Which will be our BE. So our break even, we could also use this short abbreviated form for it, BE. So BE is actually it's work more likely like a stop loss. For break even is when you are in a profit, right? But then you still want to stay on that position. So you might shift your stop loss now to your entry price, so as you are trading in a risk-free position. So for example, if instead of that trade to go that is going against you, but it's actually going in your favor, you can decide now to shift your entry price now to your entry you could shift your entry price to the current market price now to make sure you are in a risk-free trade, for example. So now you shift your stop loss. So now you say, okay, I want to risk 10%, or for example, the dollar form $10. But now, since this position is going in my favor, I'll shift my stop loss now to my entry price, so as I'm having a risk-free position. So for example, I'll give you a practical example of it. So for example, if I have my position size here, and the my entry price was around here, and my entry price was around here, and the market now is going my position, is going my way, like this. So what I could decide to do, and this was where I got into the trade. So I could shift my stop loss now to my entry area, entry price, so as to have a risk-free position. So now, even though that trade should go against me now, I won't be losing anything. That is when you are on a you are on a BE, okay, you're on a break-even position. And there's more even advanced way also to like mitigate or follow my position if I don't want to BE. So you could use a trailing stop. So there is one type of position, one type of order that we call a trailing stop, but in our own case, we won't really need it that much, but it's good if you know all these things. So there's what we call a trailing stop. So a trailing stop is more of like a type of stop loss you use that actually scale up as soon as your position is going higher. So as long as the trade you are on is moving upside, that trailing stop now will start to scale up by itself. If depending on how you set it, maybe based on percentage or real number, if you put it, for example, like, okay, if this trade should go up 5%, you should scale up, you should trade up side 1%. So which means anytime your trade goes up, your stop loss now will move upside 1%. But if that trade should move downward with a certain amount of percentage, is going to then draw back down. So it's more advanced way of like staying in a trade in a longer way, making sure that you are following the chart as it's going to be able to be more profitable in the markets. So I believe all the definitions that I just made to us right now, we understood this very well. If you understand all the definitions of these terminologies in the screen, please type one in the chat box, let me know before we move on for today. And just do some closure on when it comes to risk management. And probably I just brief on what we talked about the last time when it comes to risk management. So if you understand very well what we talked about, please type one in the chat box. Okay. Please, do we all understand this? I hope we all understood all the definitions that I gave based on all of this. And so, for example, if this is my I'll break down, right? Let's be more practical on how you can use all of these things, even just looking at this setup here. So now, for example, I have an analysis here, right? Which on this analysis I have 1:3. So why do I say 1:3? So technical breakdown, you can see here, if I click on this, on the green side here, where I have my mouse, you can see what is written here, our risk to reward ratio, which is 3.1. And this is a practical example of a 1:3 reward ratio. And you can see here is being written 3.1, okay, 1:3. But then the percentage now here, it matters a lot. You can see the percentage target on this, the target here is like 8%. This is what makes the difference in the market, okay? So whenever I tell you that, okay, you can enter a position and target 1:3 and make a $30, or you can make a $20, depending on your capital, right? And the leverage. So the last time there was a question that was asked that how can you use a certain amount to make a certain amount? It depends on your risk to reward. So you can have a 1:3 risk to reward on a trade, and you could be making potential amounts depending on your capital that you use to enter that amount and depending on your leverage that will just be fine here. So now imagine that your leverage multiplier is not 5, is 10. For example, the maximum that we recommend in our team. So on this position now, you took Ethereum with this type of setup, right? So you can see this is a 2.58 stop loss, right? This could be lesser or it could be more than that, but still be a 1:3 risk to reward ratio. Okay, but then the percentage is different. Okay, but then what really matters when it comes to the amount you can make in a particular trade, what determines that is your capital and the leverage that you are using. So if you are using a 5x leverage, your expectancy in profit will be different from someone who is using 10x leverage. Okay. So now, if you have, but the person who entered that same trade with you entered with a $10 risk, but then with a 5x leverage, the person who is eventually in that same trade and use like a $10, but a 10x leverage, will make it potentially more profit than the person who is using 5x leverage, for example. Okay. So now, our entry here would be, so you know that, okay, when we are doing our analysis, we said if you want to go on a long position, you take your trade from the order block. And you can see from here that we have another block here, right? And we have a break of structure, which you know the definition of it. Why did I take a long position on this trade? Because why? The market was moving with downtrend, but then we had a choke, okay? A change of character. That is a shift in market sentiment. Like the market that was going in a downtrend before, now there is a shift in the market appetite now that it's now in an upward direction. Even though this trade is a trade that has missed entry, it later came to the higher time frame order block and it's kept moving on from there. So this for me, I consider it a missed entry already. Okay, because this order block is valid. The one beneath it is also valid, but the price eventually did not come to this order block, but it came and reacted from here and it started to go up. Because if I should go to the higher time frame, like for example, the 4 hours, you will see here that even from the, no, it's like from the 4 hours, it's not very, very visible, but from the 1 hour, that's where this order block is very visible. This 1 hour order block here, that's where market reacted from and it's going, and you can see this is really painful and it's almost close to my target. Okay, but then it goes on like that. So now let's come back to us based on what we were talking about. So now here clearly you can see everything that I put here is where applied here. Okay, so now our entry price, that is 391.14, which is where I mark here on the order block, right? The entry price, and then I have a target, right? This will be my take profit level, and I have a certain place in which I say, okay, whenever price gets here, I want to be out. Okay, which is like I say, whenever price goes down below 2.5%, I want to be out of that market. So this is how a disciplined trader and you yourself should be trading. Okay, but then when it comes to your capital, you know, okay, in your business you should have your capital. So let's say, for example, your capital is $100. You should have a risk amount. Okay, from that risk amount, that is where you calculate your position size. And the last time also I showed you how you can do your position size. A simple way you can calculate your position size, okay, the amount that you have to buy. So for example, let's just do a practical on how you can calculate your risk amount. So if my risk amount is $10, so which is like 10% of $100 from my capital, which is $100, right? So now, and I have my entry price already. I have my stop loss, which is 2.58%. The next thing I have to do now is go to my calculator. So I go to my calculator. Where is it? So now, something I want to do now is I'll take the $10 to calculate my position size now, to know the amount of position I have to buy. I'll take $10, then I'll divide it by the distance to stop loss. And the distance to stop loss now will be the percentage that is giving me here from my stop loss. Okay. So now, for me to even be able to set this at all, I want to make sure my stop loss is below the lowest low in the market, the current lowest low in the market. So where market go to, you see, that is the same thing I did here. So all of this, you should know them by now, based on analysis. But then if you don't know, more practice, more classes that we'll do, we talk much about that. So just know that for me to have a proper position sizing, I have to divide my risk amount by the distance to stop loss, which is 2.58%. 2.58 divided by 2.58%, which will be equal to 38. Okay. So if I should divide it now, the amount of BTC now, the amount of Ethereum I'm supposed to buy will be 38. Okay. So then I use my leverage now so as to be able to buy this amount of Ethereum. Okay. So and if you go and you plug that in, that will be giving you the exact amount that you want to risk. Okay, this is how I get my position size. And what I do is I copy this. But in our case, it's not that, because we are not trading directly from the exchange. But then my position, my risk amount now, my position size now is this. Okay, and that's how I calculate it. You divide it by your risk amount, depending as the case might be. So in this scenario, the example I make for you with the $100 capital, if I'm risking $10 per trade, the amount that I'll be risking now will be that. It will be the formula is risk amount divided by distance to stop loss. It will equal to the position size. Okay, so which in this case would be 38. Okay, and my stop loss now will be around here. And we already said the risk amount is $10, and the leverage maximum that we recommend to you is 10x leverage, or you can use 5 as the case might be. And also, you have to look out for your liquidation price. Your stop loss can never be below your liquidation price. It has to be far away from it. Okay, so you cannot place your stop loss below your liquidation price. You know what your liquidation price is. If price should go to your liquidation price, you're losing everything. Okay, and your win rate, this doesn't have much to do with your trade here, but it does. What it does is with your trade is it matters at the end. So when you have your overall trading, so what it does is it monitors how effectively, how well you are doing in the market. So your win versus your losses. So if you are winning more than how the time you are losing, that's your win rate. So it doesn't have really much to do with what we are doing here. So your break even now. So for example, if this trade was going in my direction and it came to my entry and it was moving, what I could do is I just pick here and I move my stop loss now and I move the price to my entry here so as I will be trading without risk, even though the price reversed and it eventually was going against me, I won't lose anything. The worst it can do is to hit my entry price and I'll be out of that market. So, and I believe we get all of this, and you can see how all these things that we show you can really matter to what we are doing here. So now, you know that okay, if each setup, right, would always be different from each other. A trade that you might have 1:3 that will be giving you 8%. In another setup, it might be 15%. In another setup, it might be 10, depending on the setup, okay, and how volatile the coin is. But then it's very essential for you to have this setup, to have an entry, like a predetermined entry price, your target, and also your stop loss position. Because why? Crypto is very volatile. If you just trade blindly, you will lose a lot of times. And I promise you, if you are tracking your trade enough, at the end of the day, if you are just trading blindly like that, if you do your calculation very well, you see that your win rate won't be accurate if you calculate it. We have the way we calculate, and the simple example I gave you was that if you trade 10 times and you lost 3 times, your win rate will be around 70%. But if the case is the opposite, your win rate is 50-50. That means you are losing 50 times, but you are also winning 50 times. You are not actually making any money. Okay? But if your win rate is around like 60%, it's not bad. 65% is good. Okay? A perfect win rate is around, if you are having 65 win rate to 65% win rate, you are a good trader. It means you are a good trader. And actually, our exchange does that for us, actually calculate our win rate based on the trades that we are taking. There is the way you can check that on your exchange. And maybe one of these days I could also show us how that works. But then this data, they don't lie on our exchanges, okay? Because if you are just taking trades blindly and you are believing that I'm making money, but maybe the money you are actually making is smaller than when you lose. That means you are not taking risk management really very well. You are not managing your risk very well, and that's not good on the long run. So I believe we are able to understand what I explained here this evening. If you understood what we talked about, just type 1 in the chat box. And if there's any question, please, you can ask, please. Do we have any question, please? If you have any question, you can just type in the chat box. Okay. Leader Timido also said they understood. That's great. The other people in chat box, I hope you understand the concept and also all the terms that we talked about and how they matter when you are doing your risk management. All right. If there is no question, I believe we all understand what we talked about. And in the absence of no question, what I will just say is that try to apply all these things when you are doing your before you can, please, I'm still waiting for the setting for HTX. Settings for HTX. Leader to media, please, you can unmute. I can't remember the HTX. Settings in, can you please unmute us?
Everybody, yes. Yeah, get me.
Yeah, good evening, sir.
Yes, no, I'm talking because I complained that for HTX trading in RoyalQ HTX, we have only one X.
One
And
is leverage.
yes, the leverage is just one X. So, and when you change it inside the exchange itself, it remains the same. You still come back to the one X.
Oh, I never noticed that, but I never noticed that because I personally I don't use HTX,
Yes.
but I don't know if any of our leader here has
Nobody.
mm, Because me personally, I use Bybit on Binance, but HTX I can actually try and look into it and see if there's anything I can do about it. I can do.
Yes.
I'll try my best to see.
I mean, they say Bybit also have that same problem of one X.
Oh, really?
Yes, for Bybit. How do you go about that for Bybit? RoyalQ, it is one X, not
Yeah,
like in Binance.
yeah. Can we talk about that on private?
Yes.
Okay, if we can do that, it will be best.
Okay.
Mm.
Yeah, thank you.
Okay, sir. So if we don't have any other question, we'll be calling it a night, and I would also like to commend everybody to always show up for the classes and make sure to always ask questions. So we also have our class, every day up to on Saturday at the same time. Always show up, please, for all the classes, and make sure, most importantly, things that we are learning here, try as much as possible to practice and apply them to your trading. And I'm wishing you a great profitable week ahead. Yeah. If we have anything, any other leader who wants to add anything, if not, good night, everybody.